Where do you park your cash when it comes to short-term financial goals? Sure, we have savings and GICs, but here's another option that you may not know about: money market funds. Hey guys, it's Adrian here, the Canadian in a t-shirt, and today I'll break down money market ETFs and how you can use them for short-term investing. You know me, I'm all about building long-term wealth. My entire channel is about investing in stocks, ETFs, real estate, growing your money over years and decades. But what about the short term? What if you need this money in 1 to 3 years? That's what I want to cover today. But first, I want to give a huge thank you to BMO ETFs for sponsoring this video. This is a topic I've wanted to cover for a long time, and for short-term investing, BMO ETFs have some very competitive products, so this sponsorship was a perfect fit. Now, if you have short-term money goals, say you're buying a house or your child is going to university in 2 years, you have a set deadline. You need this money on this date, and you can't risk it, so how do we invest? Well, in the short term, the stock market is risky and unpredictable. We've seen wild swings up and down when looking at a small time period, months to a year. In the long term, over 5 years, 10 years, yes, the stock market can give us powerful, reliable growth, but what if we can't wait that long? Well, the traditional approach is to hold your cash in a high-interest savings account or a GIC. These are great options. You won't make a lot of profit, but the principal is guaranteed. It's very low risk. The money will be there. It can't go down even if the market drops. So you'll get peace of mind, but you will be locked in for a set period of time. Right now, I'm saving up to buy a rental property in the next 2 to 3 years. That's my short-term goal. So I'm putting money in a savings account and short-term GICs for that peace of mind, but I'm also combining it with money market funds. What is that? A money market fund is a low risk and liquid investment, so it's great for short-term goals, but it's not cash or a bank account, it's an ETF, an exchange traded fund. You know I love ETFs, but these ETFs don't hold stocks, they hold highly liquid, fixed income assets. So these money market funds contain bonds, treasury bills, commercial papers, banker's acceptance, basically cash equivalents. That makes them low risk and much less volatile than stocks. They're not designed for long-term growth, but they pay out reliable cash flow every month. That allows you the chance to beat inflation while still preserving your capital. The money market ETF that I'm investing in is ZMMK, the BMO Money Market ETF series. This is ideal for my short-term goal of buying a house. It's basically just a collection of fixed income assets, so bonds, treasury bills, commercial paper, again, cash equivalents. Here's the cool thing, this ETF doesn't contain any 30-year government bonds. It's focused on short-term assets. Everything in this ETF will mature in 1 year or less. In fact, the average term to maturity is only 90 days, about 3 months. So ZMMK is specifically designed for short-term goals and liquidity. That money is there and available when you need it. It's not locked in like a GIC. And you get all the benefits of diversification you normally get with an ETF. You don't have to pick and choose individual bonds. Believe me, that's not fun. Just buy this ETF and you'll invest in 205 different bonds and bills all at once. They are 100% Canadian and they are all A1 credit rating or higher. And again, most of them have a maturity date of 90 days or less, so low risk. As an investor, the main benefit we get is reliable cash flow. As of today, April 18th, it pays out an annualized distribution yield of 5.16%. That's how much passive income we receive every year. You'll notice that's higher than the interest on most savings accounts or short-term GICs. Make sure to visit ratehub.ca as GIC interest rates can vary. And we receive these distributions every month. That's great. Just like any ETF, there is a management fee built into the share price. Luckily, the MER, the management expense ratio, is very competitive at 0.13%. So if we invested $1,000 into ZMMK, it would only cost us $1.30 a year in fees. I'll get to the performance in a bit. First, I want to highlight some of the pros and cons of money market funds. I mentioned liquidity a few times. It's very important, especially for a short-term investment. Whenever you need this money, you can sell this ETF and withdraw that cash. It's not locked in. This is a huge advantage over a GIC. Most GICs are non-redeemable. So if you buy a 2-year GIC, that money is locked in for 2 years. You can't take it out. That's not liquid at all. If you need the money before the maturity date, you'll face steep penalties to break a GIC early. You could lose all of your interest income, which defeats the whole purpose of a GIC. ZMMK is much more flexible, and remember, they pay out their distributions every month, so that cash flow goes right in your pocket. It's a great mental boost. It keeps me motivated to save. This is important. Even though money market funds are very low risk, it's not zero risk. Your principal is not 100% guaranteed. But for me, I'm comfortable with a smaller amount of risk for a chance at greater returns to combat inflation. And you don't have to choose one or the other, you can try a hybrid approach. That's what I'm doing. I'm parking some of my cash in savings and GICs for the peace of mind and security, and the rest I'm putting in money market funds. Remember, the goal of money market ETFs is to preserve capital and earn reliable cash flow. We're not going to see the volatility of the stock market, but we're not going to see huge growth either. I'll say it again, this is only meant for short-term goals. If your timeline is longer than 3 years, don't hold on to these funds. Frankly, you'll be wasting your potential returns. For long-term investing, there are a ton of BMO equity ETFs, like ZSP and ZEQT. I already have a whole video on those, so check it out. Back to ZMMK, let's look at the stock chart. You'll notice a pattern of recurring fluctuations, almost looks like a heart pulse. That's totally normal. Every month it goes up, and at the end of the month, a sharp drop, and it keeps repeating. That's because of the distribution. Once a month, that cash flow is paid out. That money comes out of the funds, so we get a sudden drop. That's totally normal. In fact, the same thing happens with regular stocks that pay out a dividend. But with stocks, there's constant fluctuations, so this dividend drop is usually hidden behind the noise. With ZMMK, the fund is designed to be steady, no noise and random market swings. That's why this distribution effect is so apparent. At first glance, the graph looks a little funny, but if you look at the numbers, it's actually very steady. It's designed that way, with the share price aiming to hover at $50 a share. Those peaks are 50.1, and those valleys are 49.9. It's only a 10-cent swing. So yes, the share price is steady. There's no long-term growth, but that's the point. Our profits come from the monthly income. If we look at the cumulative performance with the monthly distributions included, now we see a steadfast upward curve. And that's the goal. Low risk and preserve our capital and collect reliable monthly cash flow. And again, this money is always liquid. That's exactly what I want for my short-term goals. I'll say it again, it's not for long-term investing. Don't make this your retirement fund, but for the short term, 1 to 3 years, this is perfect, in addition to savings and GICs. So there you have it. That's the power of money market funds. Thank you again to BMO ETFs for sponsoring this video, and make sure to check out bmoetfs.com for all the details. I'll include links to everything in the description box below. Thanks everyone, and I'll see you guys on the next episode of The Canadian in a T-shirt. Bye guys.